Hello and welcome to our webinar, Should You Convert or Not Convert by December 31st. My name is Eric Danielson. I'm the Communication and Client Services Administrator for AFP. We will be recording this webinar and recording future webinars as well. We will host a Q&A session afterward, and we will stop recording before the Q&A. And the video for this webinar will be posted to our website within the next few days. So in order to make sure everything runs smoothly, we've disabled mics and muted videos, or disabled videos and muted mics. If you have any questions during the presentation, please just feel free to post them in the chat. You can see our little chat instructional diagram there. So once everything's finished, we will allow people to unmute and ask their questions and address any that are in the chat as well. So if you do have any suggestions for future webinars as well, you can put those in the chat, or you can just shoot us a message or give us a call afterwards. So with that being said, I will hand things off to Terry and Nathan.
Great. Thank you, Eric. And welcome to our E3 Financial Fridays webinar. This month, our topic is looking at whether one should be converting or not converting by the end of the year, meaning that if you have money sitting in a retirement account or an IRA, should you do a Roth conversion, move that money to a Roth IRA? So as we got into this topic, we realized there's a whole lot surrounding this, and there are a lot of exceptions to the rules. We wanted to cover a bit about inherited IRAs, but that, quite frankly, is going to be a whole separate webinar somewhere down the road. There have been a lot of changes. Secure 2.0 came out in 2022. We finally got the regulations, final regs on that in July this year, July 18th. So that has helped to clear up some questions that many of us have as to how this thing should be rolled out in certain aspects. And we do realize that Secure 2.0 has yearly changes attached to it. So it's one that you almost have to look at it every year to say what is changing and what are the implications, or could there be implications to your situation. So with that, we will kind of dive into this, but we'll also talk about something called the double whammy, which is kind of a minefield for people that they may not see what is happening down the road. So with that, let's get into the particulars here. So to start off, we just want to talk about what is a required minimum distribution. And this is a minimum amount you're required to withdraw from your retirement accounts each year. The IRS requires RMDs from qualified retirement plans such as 401ks, 403bs, 457s, traditional IRAs, and SEPs. So there's an asterisk there because if one is working past their required minimum distribution age, and for people, for this year, it would be 73, the age 73. If one were working in the year that they turn 73, they are not required to take a distribution from a qualified retirement plan, such as a 401k, 403b, 457 plan, but you are required to take it from a traditional IRA. So there are a lot of exceptions here. That's one to just kind of point out, depending upon the actual time that you're going to start. In general, you must take your first RMD no later than April 1st of the year following your first RMD year. So let's say you turn 73 this year. This is your first RMD year, but you have until April 1st next year to take that first required minimum distribution. However, because you've waited until April 1st, that then means that you have to take two distributions in 2025 to satisfy your second year. So that one would have to be taken no later than December 31st. The third thing to note is that there have been pretty hefty penalties if people did not take their RMD in a timely manner. So let's say you did not take your RMD a few years ago and you realize that you should have taken it. They will allow you now to go back and do a correction if you're going to do it within the previous 2 years. And what they also did with Secure 2.0 is they changed the excise tax from 50% to 25%. So the penalty was much greater prior to 2022 than it is now. So they've moved it down to 25%, and that's still pretty significant if you're needing to take a distribution. And if you correct your oversight, then they will possibly allow you to reduce that penalty down to 10% now. So these are some of the changes that have been occurring with Secure 2.0, in addition to things that have been in place over the last several years.
Yeah, so as we've seen, and as we will see, there have been many changes with retirement accounts. And one of those changes is when the required minimum distributions have to begin. For a long time, the rule was the year in which you turn 70 and a half, you have to start taking your required minimum distributions. That was the rule until January 1st of 2020, when 70 and a half changed to age 72. And that was the rule only for a few years in 2023, when we moved to really a two-tier required minimum distribution beginning date. So with the passage of Secure 2.0, for those born before 1960, your required minimum distributions now will begin the year in which you turned 73. For those folks born 1960 and later, that age is now 75. So just over the course of a few years, required minimum distribution beginning dates have changed from age 70 and a half to 75. And that's where they currently are again for anybody born 1960 and later.
And some of that is really taking into the account that they're expecting people to live longer. So, and that is really part of what we are looking at here, is looking at how you calculate your RMD and the table that is now used to identify what that distribution amount needs to be. So how it's calculated is we have to identify what your value was in your IRAs, your retirement accounts as of December 31st. Of course, you don't know that until the following year in January. Then you know what your total, your value was on that particular day. And it is also one here with a little asterisk in the sense that your IRAs can be commingled. I mean, not commingled, but you can aggregate all your IRAs if you have more than one together to identify what that total value is. And then for your retirement accounts, you have to look at that separate and take the calculation to that one separately. So we take the value, and then what we do is we divide that by the IRS life expectancy factor, which is found in publication 590B of the IRS code. And so what we are looking at is the table that is being used here is called the uniform table. There are actually 4 different tables, but the uniform table is the one that's used most frequently. There's a single, a joint, a last life survivor, and then the uniform table. So what we do here is we take the value, and let's say we have a value of an IRA as of December 31st of $250,000. And let's say that you're turning 73 next year. And so that factor in the table equates to 26.5. We take that, we divide it by the total value, and that gives us a required minimum distribution amount for 2025 of $9,433.96. So you have to take that minimum. You can round it up a little bit, but out of that, typically people are going to withhold federal and state tax as well. And then that gets reported on a 1099-R for tax purposes, so that you can kind of understand, where this is coming and how that is going. This table is one that just actually came into being in 2021. They had been using a previous table that assumed that people weren't living quite to, maybe it was like 100, 101. The new tables assume people are living to 120 plus. So, and in the change of the table, they reduced the distribution factor. So technically, people are now taking out a little bit less than they had been in the previous tables. And I think the other tables had been around for several years. I mean, like maybe 30, 40 years, quite some time. So they don't make this change very often, but that's kind of how that is calculated. So we have to look at this calculation every year. We look at it because the factors you can see are not reducing by one. They assume that if you've gone from age 73 to 74, they give you the benefit of the doubt that you're living longer. So it doesn't go straight, down in numbers necessarily. The factors are based on someone living a longer period of time.
As we begin to look at Roth conversions, one of the key things that we need to understand is the difference between traditional retirement accounts and Roth retirement accounts. And there are three main differences that we're going to look at here. So with traditional IRAs, traditional 401ks, etc., typically, not always, but typically, the money going into these accounts as contributions is going to be pre-tax money, meaning it's income that will not be taxed as income, if that makes sense. The flip side of that is Roth IRAs, Roth 401ks, Roth 403bs, etc. The contributions going into those accounts will be taxed as income. So it is a post-tax contribution. So traditional is pre-tax, Roth is post-tax. Now, when the money comes out as a distribution, it's the opposite. For a traditional IRA, traditional 401k, traditional 403b, etc., the distributions are taxed as income. There can be penalties involved if it's prior to age 59 and a half, but typically once you get to retirement age, you're paying income taxes on the distribution, but not the contribution. The Roth IRAs and 401ks and 403bs, etc., it's the exact opposite. The money is going in as a contribution after tax, but then it's going to grow tax-free and it will be distributed tax-free as well. So those are the opposite of each other, contribution, distribution. Now, for our discussion, we're talking about required minimum distributions and Roth conversions. It's important to know that the traditional accounts will be subject to required minimum distribution rules, which we were just talking about. But the Roth IRAs, 401ks, 403bs are not. Now, that is a recent change because Roth 401ks and 403bs, I believe as well, had required minimum distributions prior to these new Secure 2.0 changes. But that's one of the things that Secure 2.0 did is it aligned the RMD rules with Roth IRAs and Roth 401ks and 403bs. So those are three important distinctions, three important notes to note the difference between the traditional and the Roth accounts.
And there can be minefields in front of you. What we are finding is that a lot of people have been great savers. They've listened to what they've needed to do. They've put the maximum amount they can into their 403bs or their 401k plans. And so they have a lot of money sitting in these pre-tax accounts that are growing as things move along here. So what we are recognizing is that if people have not stepped into the future to see what that RMD, their required minimum distribution amount, is going to look like, they could be in for a very big surprise, especially because now they can wait until 73 or 75 to take these. So unless you can kind of look into the future, which we can do in financial planning, and Nathan is going to show an illustration of that here in just a minute, it kind of helps us to understand that you might need to start taking your required minimum distributions earlier to counteract some things that could be coming at you. Because if we wait, for many people, what they will find is that they have to take out more out of their retirement accounts than they actually need to live on. And that could bump them into a higher tax bracket, in addition to the fact that they could be subject to higher Medicare premiums on a year-by-year basis. So unless we can kind of look at this prior to that time frame, can some things be done to unwind some of this i.e. conversions. So that's one thing we want to be looking at and focused on, and that's why Roth conversions have become such a big thing here. The other one to realize is that if you are married and one of your spouses predeceases you, you will then move into a single tax bracket versus a joint tax bracket, and the Medicare premium schedules also will change. So you could be actually needing to pull more out than you were when you were able to file a joint return.
So the good news is there are some solutions to that minefield. There are ways to avoid some of those mines. For people who are still working, one of the things that you can do is to begin to switch a portion or all of your 401k contributions from the traditional side to the Roth side. What we're seeing is more and more employers are offering Roth 401ks, and that allows people to make Roth contributions with their retirement savings. It will affect your tax burden today, but it will help avoid some of those mines in the future. So that's one solution to that minefield. Another is to implement Roth conversions, and we're going to talk about this more in depth over the next few slides. But that is simply moving money from the traditional side to the Roth side, and that's what a Roth conversion is. So that's another really important tool that people can use to avoid some of those mines. Another one is when people do reach the required minimum or actually age 70 and a half. So we talked about how required minimum distribution ages have changed from 70 and a half all the way to 75 now. When you're 70 and a half, this age hasn't changed. You can utilize what's called a qualified charitable distribution, a QCD. And that is simply sending money directly from your IRA to a charity or a 501c3 organization. And what that will do is it will reduce the taxable amount of your required minimum distribution. And so it will allow you to get tax benefit for the charitable distribution and still be able to use your full standard deduction at the same time. So that can also be a very powerful tool to use to reduce taxes and avoid some of those tax mines.
Yeah, and that can really be confusing now that they've changed the RMD age to not be the same as your
Yeah.
QCD age, and communicating that can get kind of wonky. But so what is a Roth conversion? And as Nathan has said, it's simply converting assets, and it can be cash sitting in your IRA, your qualified plan, or it could be securities. It doesn't have to be a set dollar amount. You can convert whatever you want over from traditional to a Roth. And so a lot of times if people have a qualified plan, we flip it to an IRA, but you can flip it straight to a Roth. But the point is that we're trying to get it into a Roth IRA. The amount you convert will be taxed in the year of the conversion at your top marginal tax bracket. So that's an important one. And as we mentioned before, that can bump your taxes up. And if somebody were doing this in the fourth quarter, we would want to look and see what that tax consequence is, because if we're making a fairly large contribution, we might want to be making an estimated tax payment for the fourth quarter so we don't get hit with a penalty going into when we're going to complete our tax return for 2024. So another thing that has come up here is you might have heard this term called backdoor IRA. And for some people, if they don't qualify to put money into a Roth directly, they could put money, after tax money, into a traditional IRA, which you can put in up to 8,000. And so 7,000 if you're under 50, and if you're over 50, it's 8,000. So that's for 2024. So if you put that money in and it's after tax money and you only have that money in that IRA, you can convert it to a Roth. and it will be right, you'll be moving it straight into that Roth account. If you have some money already in an IRA though, and you put money into an after-tax contribution into that IRA, then you can't say 100% is going to go over to the Roth and not be taxed because it's pro-rated. So that's one that we really have to kind of look at and say, do we have anything that could be impactful here if we're trying to do that maneuver to get money into a Roth? But we're not allowed to say that word, backdoor Roth, which I just said. So the conversion must be completed by December 31st in order for it to be counted for the year that we are trying to establish this. So why do a Roth conversion? Well, really, it's being able to look down that road and say, if I don't do it, you can get hit with some pretty hefty taxes. You could be bumping into a much higher tax bracket, and you just don't have any recourse. You're kind of locked in. So if we can kind of take this runway before we get there, or even if we know we're hitting it and we're 73 at this stage of the game and we see this wall coming, can we look at this and say, let's do some significant conversions and see if this will be impactful in a benefit? So we've had sometimes people come to us and say, well, somebody told me I should convert all of my money, and sometimes that's not a good idea. So again, you have to kind of look at this and really weigh the pros and cons when you're looking at which strategy is going to work best for you. But by doing that, what it will do is reduce your future required minimum distributions down the road. At least we sure hope so. And then you have a bucket of tax-free money sitting in a retirement account, a Roth IRA, that is now growing tax-free and tax deferred. So that's the purpose of what we're trying to do when we do a Roth conversion. The other area that we need to be mindful of is what happens with your Medicare premiums when you are starting to pay those. And when you are 65, and if you're on Medicare at that particular point, you do recognize that there is going to be part of your Medicare Part B that is going to be subject to an adjustment in that premium based upon where you fall with your income tax too. And Medicare is determined by looking back 2 years. So if you're 65 this year, what they are doing, Medicare is doing, is they look back to how you filed your taxes when you were 63. And that is the number that they use to determine what your premiums need to be. And so that there's always this 2-year look back rule as we go forward as to how they're determining your Medicare premiums. So that could also be a big whammy because they are very steep, that threshold of moving from one bracket to another in the Medicare premium, what you're subjected to. Another area is looking at estate planning purposes, why one would do a Roth conversion. So if you're sitting in a lower tax bracket and your beneficiaries could potentially be in a higher tax bracket, and you want to make sure they're getting the money moved over that would be beneficial to them, and you want to give it to them in a tax-free format, this would be a solution to that problem. So again, sometimes we are looking at this not just from your perspective, but also what your plans are moving forward and how your estate will handle this in the future.
So a Roth conversion is really beneficial. Yes, we're going to look at 2 ways that Roth conversions are beneficial. One is that over time, we see that Roth conversions will add to a person's overall wealth. And this is due to 2 main reasons, which we just touched on. One is tax-free investment growth, and the second is lower required minimum distributions. So we see here a couple of charts with a lot of blue bars, and we see that over time, the net worth in both of these charts is increasing. But what we notice is that when the chart on the left is increasing at a steeper rate, and at the end of the plan, in this case 2056, there's considerably more money in the person's plan. So we see that one, doing Roth conversions and given enough time, that these conversions do result in just a greater amount of wealth for the client that does complete these Roth conversions. And again, due to tax-free investment growth and lower required minimum distributions. So we'll look at the next slide. So not only do Roth conversions over time typically increase a person's wealth. And again, this just depends on each individual situation. But we also see that Roth conversions lead to a better, we'll say, quality or value of their assets. And the reason is that we're adding via Roth conversion more and more money to the Roth IRA accounts. Because the truth is, when you are in retirement, $1 in your Roth IRA is worth more than $1 in your traditional IRA. And that's because, like we said a few slides ago, when you take money out of your traditional IRA or traditional 401k, etc., you have to pay income tax on that distribution. So that dollar will be taxed and you'll receive net less than $1. Whereas with the Roth IRA, if the 5-year, holding period has been met, and if you're, 59 and a half, that dollar is worth $1. So the dollars in your Roth IRA are worth more than the dollars in your traditional IRA, traditional 401k, etc. So those are the two benefits to think of. Is a Roth conversion really beneficial, or how exactly is a Roth conversion beneficial? Over time, generally, it will lead to greater wealth due to the tax-free investment growth and lower required minimum distributions. And then you'll just have more money in that tax-free Roth IRA, which gives you that bucket, sometimes we call it, of tax-free money. So those are two ways that a Roth conversion is truly beneficial.
So we've talked a lot about Roth conversions and getting the money in there and the reason and the purposes. But when we're looking at an account, we then also have to identify whom you're naming as your beneficiary on these accounts. And you have choices here as far as what you want to do in this particular area. Typically, we ask people to have a primary and a secondary beneficiary named. And many times, if people are married, they're going to name their spouse as the primary. And then the secondary could be adult children. It could be a charity. It could be a trust. But it could be really anything you want. It could also be that you don't name anyone and it goes into your estate, and that's usually not the best decision to make. There have been really few exceptions to that rule, but we do want to kind of explore this area and look at what happens when you do name a particular person, and then how do the assets from your IRA flow to that individual. So we have individuals, trusts, charities, or no beneficiary. And these are our choices. And we want to also review these on an annual basis to make sure they're still up to date and they're current as to what you want to be happening here. The changes in trust language for Secure 2.0 have caused a need for people that have named a trust to review it, because there are two primary forms of trusts out there: conduit and accumulation trusts. They have to satisfy the 5 rules of a see-through trust. And because of these changes in Secure 2.0, it could actually blow up some trusts and not make them valid. So it is very important for people, if they haven't reviewed their trust, if it's named as a beneficiary in any of your retirement accounts, to have that done, and to be thoughtful when you're thinking through how this might happen. How is this going to play out? And does this still make sense for you? And is the language written in a way that qualifies? So going back to your estate attorney is probably a very important thing to put on your to-do list and make sure that that is getting done. So the other thing is how people are receiving their money, and that change was Secure 2.0 as well. So what has occurred is, prior to and it could have been even just Secure Act, I'm trying to remember, but prior to December 31st, 2019, there was something called a stretch IRA or a stretch payout period that it would go for a beneficiary's life expectancy. That is no longer available. We basically are down to a 10-year rule now, or it could be a 5-year rule depending. So this area is it's like a minefield again to kind of go through and identify whom are you naming, and based upon whom you are naming and how old they are. And if something were to happen before your required minimum distribution age, your payout might look a little bit different than if it is received after one has turned their required minimum distribution age. So I'm not getting into the details because it gets too into the weeds here. Just recognize that there have been many changes here, and it's important that we review everybody's situation as it comes.
Yeah, and with these many changes, there are a lot more complicating factors. So one of the big changes, and again, maybe we'll do a webinar on this in the future, but there are now 4 types of IRA beneficiaries. Spouses, which that hasn't changed, but some of the rules around that has changed. So there's one type of beneficiary: eligible designated beneficiaries, non-eligible designated beneficiaries, and non-designated beneficiaries. You can see there, what type of person or entity falls into which category, but each category has its own rules. And there are rules on top of those, like we just talked about, whether the decedent is before their required beginning date, after their required beginning date, whether they're taking their RMDs or not. So there are just so many rules. And the moral of the story is it's gotten a whole lot more complicated. So we just have to be very mindful of who is being named as beneficiaries of retirement accounts, IRAs, 401ks, etc. So just some closing thoughts. One is that each situation is unique. Your situation is unique. So there are no hard and fast rules, black and white. Yes, do Roth conversions. No, don't do Roth conversions. The first thing to remember here is that every situation is unique, and it's important to know the rules and how those rules apply specifically to your situation. And this is also why we really stress with our clients, we need to review your plan every single year, because as we've seen, the rules have changed. Just think back to the 3 changes now that we've seen just in 4 years with RMDs, when RMDs start. And I think that's just a really good illustration of how quickly rules surrounding retirement accounts can change. So that's why your financial plan needs to be reviewed periodically, annually. And it's also because individual situations change for a whole, plethora of reasons. So just because all of these things are changing, your financial plan should be reviewed to keep on top of just all the many things that can change. So those are our closing thoughts. We appreciate everyone joining us today on our webinar about Roth conversions and a few other topics as well.
Yep. Thank you
And
very
now
much.
I think we can see if there are any questions.